This is Andrew Stotz of Stotz Investment Research, looking at Malaysia, which has the lowest risk in Asia. There's 4 parts to this. Let's start with the GDP. We can see that overall, Malaysia's growing relatively quickly, but it's slowed down slightly from second quarter. Growth was at 4.25 for GDP for the last 4 quarters, and most of that was driven by private consumption, which was 3% of that 4.25. Exports, that's the only drag, but it's only slight. And what we can see is that investments is a slight contributor also. And if we look at country, what we can see is we have 30 million people in Malaysia, and the GDP is about 300 billion US. Per capita GDP is about 10,000 US dollars, and the market cap is about 370 billion US dollars, and average daily turnover is about 400 million US dollars. There's 913 listed companies. Earnings are expected to recover in 2017 according to consensus estimates and come in at about 5.6%. Dividend yield is above the Asia average at about 3%. And let's look at our 4 elements here to understand what's going on. And first of all, we can see the overall rank is about average, so moderately attractive. And ROE is just below 10%, so not that great on fundamentals. Valuation, relatively good dividend yield, and trades at a 1.5 times price to book. Momentum, well, that's the worst in Asia. And risk, it's the lowest beta to the Asia ex-Japan region. It's got low volatility and moderate gearing, so risk is the main thing in Malaysia. Let's look at the sector performance. And first of all, the top 3 largest sectors, well, financials is 20% of the market, industrial 16%, and consumer staples 12%. And the best sector in stock was materials, which was just barely above the 0 line for the last 3 months, and Petronas Chemical Group was up 2%. The worst sector in stock, well, the sector was telecoms, down 9%, and Axiata Group was down 22%. To get access to additional research and articles, join our free newsletter at becomeabetterinvestor.net/join, and I'll see you there.